let's start with the freshest news of the day, which I don't think is President Trump tweets. I would say the Fed. As you all know, Fed signaled overnight that then there won't be any interest rate hikes for the rest of 2019. They also talk about inflation. What's your take on it? Is it good news or bad news?
I just read something that we wrote this morning post, and they put it nicely. They said the Fed outdubbed the doves. So the expectations were high. We thought it was going to be difficult for them to meet what's been priced into the market already, but this was a little bit of a surprise. The reaction of the markets has been mixed because there's a view that if they're as dovish as they are, what does that mean for the economy? But I kind of think that this is a little bit of a Goldilocks environment. They pointed to 2 points of growth, no rate hikes, balance sheet normalization's been pushed out, or actually it's coming to an end. So this is the kind of environment in which we've seen in the past, and I suspect we're going to see again, just a reflation across all asset classes.
You said you were surprised. How surprised is it? And are you going to revise your view on global equities market coming forward?
So it depends which market. We're, and I'm sure some of you have already read this, we're really positive emerging markets. So this just reinforces that because, a combination of low rates, a potentially weaker dollar, easy financial conditions is a great recipe for EM. And you've seen some of that translate into market performances here. And that just reinforces our view that this continues. Obviously, there's some fundamental factors behind it as well, but just easy money is a great recipe for EM assets. We've seen that in the past. We're beginning to see that again. So we stay really positive EM. We're a little more cautious about US markets. They're expensive. Our view on corporate earnings in the US is somewhat hawkish. This is an economy which is running at pretty close to full capacity. Labor is tight. We're seeing prices go up, although not reflected in broad inflation, but we're seeing prices go up. So margins for US companies are definitely under pressure. So we've got a market now which is trading at 18 times earnings. Low rates, yes, so that helps that multiple. But we've also got a market where we don't see any earnings growth this year.
So yeah, you answered my question. I was going to ask you whether the Fed will help, right? Because there won't be any interest rate hike. Easy money may stay longer.
So the Fed is helping. So which is why we've got an 18 times multiple, right? So to me, there's almost two conflicting forces at work in the U.S. equity markets, which is easy money, high multiple, but no earnings growth. So can they go much higher from where we are right now? It's difficult to see that. In contrast, Asia, there's easy money, but you've got 10 to 15% earnings growth. At least we think you will have 10 to 15% earnings growth over the next couple of years, which is why if we think about a hierarchy of where we would put our money right now, it's EM, within EM China, and then Europe, and then the US.
Let's take since you mentioned the US, and global equities market actually rebounded a lot. Well, not a lot, but significantly, I would say, this year from last year. Is it because investors are very optimistic about the trade war? There will be an outcome, there will be an agreement, and will that last long?
Look, I think it's a bunch of different things. The fourth quarter of last year was about as miserable an experience for a lot of people as you could ever hope for. So some of what we saw was just a bounce back, but to me the most important issue was just the pivot by the central banks. It started with the Fed, but it wasn't just the Fed. It was the ECB, the Bank of Japan reinforced its easing, and then EM central banks followed. So China, India, Indonesia, a whole bunch of central banks have now gotten into the act. So you've got this almost synchronized dovish tilt by central banks all over the world. And in that kind of environment, you can go back 50 years. And if you see a dovish central bank environment and asset valuations, the correlation is almost perfect, right? So it's no surprise that the market started moving the day after Jay Powell actually changed the narrative. And then all the other central banks followed. Now to that, you add the Chinese stimulus, you add trade, and that's a recipe for asset inflation. And that's what we're seeing. The economics and the earnings underlying that, I don't think have turned yet. I don't think the U.S. is headed into a recession anytime soon, so that's a good thing. But I think Q1 of this year will probably see growth trough. It's going to stabilize, just given easy money, etc. But I don't know that we're holding our breath for a massive recovery either. So it's really going to be a function of which market, which sectors within which market, and how much they've already moved.
Any risk of a US slowdown in the next 2 years?
2 years is a difficult time frame to call.
One
I don't think it's happening over the next 6 to 9 months. Let me put it that way.
I like how cautious, but I think that's realistic. We don't have crystal balls.
But you know, I'm more serious now. I don't think we're seeing. If we speak to a lot of different companies, 6 months ago, there was a much broader narrative that, you know, end of 2019, early 2020, you could see the economy tip over into a recession. We're not hearing that right now. So it feels like if it does happen, it's a late 2020, early 21 event.
You mentioned emerging markets is your favorite. You think there's value there. Which emerging markets that you would recommend to your clients?
Look, we've been very vocal about this. We like China right now, a whole bunch of reasons, some of which we've spoken about, i.e. the stimulus. But within the stimulus, what I like particularly is it's not the scale or the size of the stimulus this time. So what they did in 2010-11 was actually much more significant in terms of size that they're doing now. But what they're doing now, it's more domestically focused. So the VAT cut, that has a 3 percentage point impact on corporate earnings, right? All the flows that are coming into China right now because of MSCI or the Bloomberg EMBI bond index inclusion, I think are positive for the renminbi. A stronger renminbi means higher earnings growth when translated into dollars. So there's real earnings growth in China. Two, there's very little positioning. I mean, there's two types of investors who participate in Chinese equity markets. The global guys, who till last year were really uninvested, except for folks who have to, as part of their mandate, just buy China. They've increased positioning some, but Chinese markets move when local investors get into the act, right? And local investors were dramatically underinvested post the 2015 event. That's begun to change. And that's really, really powerful. Because when that savings pool gets allocated out of, you know, banks or fixed income or real estate and goes into equities, that's a lot of money. It does have the potential for market overshoots, but that's the nature of the market. Just given participation, there'll be people who hate it, and then there will be people who absolutely love it, and there's almost nothing in between. I think we're headed to a potential environment where the rally just continues for a little bit, because by no means have we reached a level where investors are saturated. Certainly not in the local markets.
So the onshore...
The onshore guys are just getting into the act.
Right. Speaking of onshore markets, we are going to do a poll. We want to poll you on where the CSI 300 will be by the end of 2019. We have 5 lovely options, which include one on the last one, the sky is the limit, as we all know. So but I do want to ask you, where do you see CSI 300 will be closing at the end of 2019? What's your
Why don't we
guess?
take the poll first? No.
You want the people speak before you give them the answer or your prediction. We give you a chart so that you know where it is. I think it's about 3,800-ish. I'm not sure. I think this is a real time. Oh, there you go. We can see. All right. So let me tell you, it's behind us. It's kind of head to head, but a lot of more people are seeing 35,000 to about 4,500.
4,000 to 4,500.
Yeah. Oh, there you go. All right.
Okay.
And no one see the.
I'm not making this up, but we were at 43.
All
Okay.
right.
We were at 43.
Go with the
yeah.
people's choice.
So that's another 10 to 15%.
Oh, there you go. Okay, so talking about that, so we always talk about that tipping point, how to get clients the interest in the onshore market. It hasn't been easy because of a lot of other reasons, right? But MSCI inclusion definitely triggered that.
Look, to me, that is the most significant event. It took, I think it's almost 5 years for MSCI to go from 0 to 5% inclusion. It took a year to get from 5 to 20. The experience of other markets in the region has been 7, 8 years to get to 100% inclusion. Now, we spoke about this a little bit earlier, but there's a bunch of different things that China needs to do to get to the 100 in terms of ease of market access, aligning with global settlement systems, ability to hedge, etc. But I think China is incented to do that right now. We've spoken about, for the first time in almost 30 years, China will be maybe 2019, but very likely in 2020, running a current account deficit. It hasn't happened for the longest time. And that means that the need for global capital is an imperative. And I think China is genuinely focused on liberalizing and opening up their markets to attract this capital. And if that happens and you go to 100%, nobody has a choice, because a lot of asset managers are benchmarked against MSCI indices. And to then be underinvested, you're taking a significant amount of benchmarking risk. So just the 20% move is about $12 to $15 billion in terms of passive capital and $100 billion in terms of actively managed capital. The 20 to 100 is, obviously multiples of that. That's the good news. The bad news is that some of this will be incremental allocation, but some of this will be money that comes out of other markets in the region. So you're going to rob from Peter to pay Paul a little bit.
Right.
Yeah.
One of the most popular questions when you talk to clients about the Chinese onshore market, what do they ask you? Is it corporate governance? Is it earning growth, or fund repatriation?
It's a little bit of all of that. I think the biggest issue is that there's about almost 5,000 companies between Shanghai and Shenzhen. For the offshore investors, the quality of information isn't great, right? So nobody has, including us, we don't have by any means a broad footprint in terms of research coverage. And if you think about global investors and their participation in the local Chinese markets, it's really 20, maybe 30 stocks that people know, right? For the kind of money that we just spoke about to be actively deployed, that needs to widen dramatically. It has to broaden. And the way it'll broaden is if the opacity of the information changes. And some of that will be the sell side and the buy side actually putting people on the ground, which they are, by the way. We're doing it. Everybody's doing it to try and understand who these companies are, what they do, where the opportunity is. Because I've always had the view that buying China, either through Hong Kong or the US, is very limited. Right. There's a few companies. Historically, the concentration was energy and financials. Now it's moved to tech. And maybe that's what you want to own. But if you truly want to own the economy, you've got to go local. But to be able to buy those names, you need to know what they do. And you need to trust the information that comes out. So, which is why the biggest issue we've had is that when we tell people China's trading at whatever, 11, local market, trading at 11, 12, 13 times earnings, it's kind of meaningless because those earnings change every week.
Every week?
I mean, estimates change every
All
week.
right.
Yeah.
How about the new tech board in China? What's your take on it? Because if you want to go invest in China tech, that's sort of like a new venue that you can.
I think it's a great idea. The irony is that between Alibaba and Tencent, that's almost $1 trillion of market cap, right? Or it touched $1 trillion of market cap. Maybe it's 900 now. And Chinese people can't participate in that value creation because one's listed in the US, the other's listed in Hong Kong. Now with Southbound, you can a little bit, but historically, you haven't been able to. With that much value being created, you should have the nation's saving pool participate in that value creation. So I think it's a great idea. It'll take a little bit of time to actually play out, but I think that's another destination where Chinese tech companies will in fact list. So it's very real. We're seeing in our dialogue with a lot of tech companies, it's a real option now.
Yeah, you're right. I mean, definitely the apps by Tencent and Alibaba are so popular. So hopefully they can get a chance.
And it's not just Tencent and Alibaba. It's the export of the capital market out of China is actually an unnatural event. It happens because there is no institutional equities business in China. It's a retail market. 80% of the market even today is retail. That needs to change. But even before it changes, I think the opportunity to participate in this value creation is important.
So yeah, the participation of the high ratio of retail investors also give the question of whether there's a bubble in Asia. Because they always see kind of a rally that go above whatever level that people think is rational, and then always a question about bubble. Do you see a bubble now, or would your clients been asking that questions to you?
I don't see a bubble right now. Could it head to a bubble? Absolutely, because of what you described. So, which is why the most important change, and this could take years to happen, is the retail pool of capital that participates moves and allocates that capital to institutions. And that's taking a lot longer than we thought it would take in China. So the institutionalization of the market, as I described, has not happened. No, it's happened, but it's happened selectively. That change needs to take place for the market to actually function like a more sophisticated normal market. But that'll happen. It's a matter of time. So we will, I think, at least for the next couple of years, we will see this absolute despair moving to absolute enthusiasm and excitement, and there's almost nothing in between, because that's the way that's retail psychology. That's the way it actually participates in markets. Either you absolutely hate it or you absolutely love it. Yeah.
In the middle could be the institutional investors, I hope.
But there are not enough of those. But this opening up an MSCI is resulting in more global participation, and that's all institutional participation. So the first 2 months of the year, northbound participation in local Chinese markets is almost $20 billion. That was more than all of last year. So, it's beginning to change.
And some of the stocks actually already breached the foreign ownership.
But that's because they only buy 20 names. So, there's a whole bunch of different things that need to happen.
So people have to know more about the companies so
Yes.
that they know what else they can buy in the markets.
Yeah.
Any last word, any ideas on going forward 2019?
Buy CSI 300.